Central banks, individuals, corporations, cryptocurrency, gold, silver is like a cheap sweater.
Bob Moriarty introduces talks about the banking sector and cryptocurrency, mentioning how they are interconnected. He also talks about 3 bank failures that were largely related to the tech sector and cryptocurrency sector.
The cryptocurrency system could really be the catalyst for the collapse. And then we saw 3 bank failures that were largely related to the tech sector and cryptocurrency sector. And now we're seeing issue with Credit Suisse, which then when we had you on again last week, you mentioned Credit Suisse could collapse the following week. And we've seen huge issues with Credit Suisse. Now First Republic Bank is having issues and getting extensions of credit from other banks there. So can we get your overall picture right now? What is happening in the banking sector? And then I guess we can go from there.
Okay, I'm going to back way up. Okay, there is $300 trillion in debt in the world. It cannot be paid, period. At some point in time, there has to be some regression to the mean, and you have to go back to financial stability. And we're doing exactly the opposite. Some of the things that the Fed has come out with lately terrify me because I'm staggered. They just dropped a 100 megaton bomb on the world's banking system. As bad as I said it was going to be a week ago or 2 weeks ago, it's going to be worse. And it all goes back to this debt. And nobody wants to talk about the debt because if you admitted it existed, you'd have to do something about it. So they've cut both legs and both arms off the financial system, and they slapped some Band-Aids on it, asking if you feel better now. It's bad, and it's going to get worse.
Can you expand on that, how this current situation that we're in is really directly tied to the expansion of debt and just the ballooning of debt that we've seen over the past half a century?
He discusses the expansion of debt over the past half century and how it has led to the current situation in the financial system. Bob Moriarty explains how the United States spent money it didn't have and how the rest of the world followed suit. He also talks about how the financial system is all intertwined and how it can come apart with just one string pulled.
You can go back to August 15th of 1971, and that's when Nixon came out with wage and price controls. And everybody's forgotten this because they remember Nixon going off the gold standard, but they forget the whole point of his address was to put on wage and price controls. And he was like Steve Jobs. At the end, he said, oh, by the way, and one more thing, we're going to go off the gold standard. So what happened then was the United States went into a period of 50 years where we spent money that we didn't have because we were the world's reserve currency. And then the rest of the world looked at it. So, gee, if Americans can print money like drunken sailors, we can do the same thing. And that was all well and good. They had free money for the last 2 or 3 years in Europe, in Japan, in the United States. And you have set up a situation that as soon as you increase interest rates, the value of bonds plummets. And since bonds, in theory, are supposed to be stable and secure, when you got a 20, 30, 40% drop in bonds in a year, you crater the entire financial system. And here's how to think about it. Pension funds, insurance companies, central banks, individuals, corporations, cryptocurrency, gold, silver, is like a cheap sweater. And all you have to do is pull one string and the entire system comes apart. And quite bluntly, I was very lucky 2 weeks ago to predict cryptocurrencies would be the catalyst for the collapse. And I was very lucky when I said Credit Suisse was in deep, serious trouble. But other people have done the same things.
Bob Moriarty discusses some numbers that the speaker finds terrifying, including the CLO market and the off-the-books derivatives market. He also emphasizes that the financial system is all intertwined and is coming unglued.
The real key here is you've got this giant financial system that's all intertwined and it's coming unglued. Now, let me give you some numbers that are truly terrifying. If you go back to 2008, Lehman Brothers was $600 billion. The CDO market was $400 billion. In 2022, the crypto market actually got up to $3.2 trillion. It's back to $1 trillion now, but $2.2 trillion disappeared, went to money heaven. The CLO market today is $1.2 trillion. Derivatives are about $400 billion, but the real danger is in the off-the-books derivatives, and that's probably a quadrillion or $2 quadrillion. Now, on Friday, and I was being a little bit facetious when I said we're going to need to start talking 2 or 3 times a day.
He discusses the announcement made by the Wall Street Journal regarding 186 banks being at similar risk as SVB, which could lead to a run on the banks. He also talks about the importance of understanding derivatives and entropy in the current financial crisis. Counterparty risk is introduced again, and the numbers coming out of the Fed are discussed.
Friday afternoon, the Wall Street Journal announced that 186 banks are in similar risk as SVB. 186 banks. So if you got under $250,000 in those 186 banks, the Fed says we're going to insure it. If it's over $250,000, the Fed's not going to insure it. That's going to cause a run on the bank on 186 banks. And the analogy of pulling a thread and having a cheap sweater fall apart is very valid.
He also talks about the importance of understanding derivatives and entropy in the current financial crisis. Counterparty risk is introduced again, and the numbers coming out of the Fed are discussed.
We should address the derivatives. Do you have a firm understanding of entropy? The stock market opens up and it goes down 2,000 points. How much money do I make? You don't make anything, because you have just introduced counterparty risk. Okay? If you buy calls on gold at 1990 and gold goes to $5,000 tomorrow, you don't make any money, because the guy who sold the call just went bankrupt. You've introduced counterparty risk because of the size of the bet. The numbers coming out of the Fed are truly terrifying, because I think they started off with this is going to be a $200 billion project program, and then it was going to be a $500 billion program. And then on the 15th, J.P. Morgan said the loans would be $2 trillion, and I'm now hearing $30 trillion. We have just introduced counterparty risk into it, and it's no longer a market bet, it's a counterparty risk bet. And the counterparty to a quadrillion of derivatives means the entire financial system is bankrupt and it has to collapse. So the probability of a cascading series of defaults is exceptionally high.